Hi, this is Randy Finney with the right side of the chart, and today is Wednesday, May 17th, 2017. I'd like to do a quick update on the markets. It's the first interesting day we've had in a while. By that I mean, whether you're bull or bear, it's just been a slow grind. The market has gone nowhere. I continue, a lot of what I'm saying here today, if you've been listening to my analysis, it's just a repeat of the same, and that is the stock market has gone nowhere, absolutely nowhere for months. You might not seem that way listening to frustration from those short, and don't hear a lot of complaints from those long because it really hasn't gone down and the trend has been higher. So therefore, if you've been bullish since the elections and long, great, more power to you. But for the last few months, I've been made it very clear, in my opinion, that just the risk reward did not warrant being long or going long despite the trend. And again, it's all been about the Qs. We're going to talk on the Qs today. That's it. I'll do a quick video update highlighting some support levels, any significant technical developments. And before I do that, because I know there are always new people coming into the site or people catching up from time to time, here's what I'm talking about the stock market not going anywhere. This is a 2-year chart, a 2-year daily chart of the S&P 500. And let me give you a clean board here and tell you what I'm talking about. You can see here's where we were. We back there, this is the SPY. We topped about 240 and change, a little over 240 back on March 2nd. You can see the pop-up box on the left there. So here we are now. As of today, we are 2.5 months into going nowhere. We're actually lower than we were 2.5 months ago, and we never even made it higher. We peaked, and when I'm talking mere basis points, less than 1% or so. Basically, we just met those recent highs. So over the last 2 months, we saw a decent drop. We saw a rally back to where we were, but again, we haven't gone anywhere. And as of today, we're trading below where we were 2.5 months ago. So we're almost about 3 months where we were 3 months ago. And that's the S&P 500. That is much more representative of the U.S. economy and of the U.S. stock market than is the QQQ, the only index. And again, I don't really call it an index. I call it a tech fund with an Amazon kicker is my nickname for the Q. So you can look at the small caps, and they've actually been in a much longer trading range, as I've mentioned many times. We haven't gone anywhere. We're trading below where we were over 5 months ago, 5.3 months ago where we topped. So right now we're about where we were 5.5 months ago. Small caps, there's your mid caps, MDY. I'm just using the tracking ETFs. There's MDY trading right now about exactly where we were. Yep, same thing, 5.3 months ago. And for those of you who like to follow the Dow, same story as the Dow will mirror the S&P 500 more closely, even though it's only 30 stocks. And same story. We're down 2.5 months ago. We're below where we were, and we're trading right now where we were almost 3 months ago. So there it is. That means that presses a point that I've been saying we've gone nowhere. Now, if you're only trading the Qs, you have gone somewhere. We had a trading range for a couple months in this recent breakout, and this to me was this, based on those charts I just showed you, was an extreme sign of non-confirmation when you see not just one index, but again, even though it is technically an index, the QQQ is mostly technology. Over half of the companies in here are technology, and the top 10 companies within the Qs alone make up over half the return. So it's really just a handful of stocks that this index is tracking, and they're going to drag the rest of them up with it when they see money flows into Amazon, Apple, Facebook, Microsoft. They're going to lift the Qs with it, and they're going to lift a lot of the stocks with it in sympathy buying. But same story, guys. Those divergences we have continue to build. We did have divergences back here that I thought would play out for a much deeper correction, and they didn't. What happened is they were burned through. We made higher highs. We reached the most overbought the market has been, if I remember right, going back at least, was it 20 years? I already put that up a few months ago. So there's a story. Divergent highs across the board on all the major indices, even more so on the S&P 500, as I just showed you there. Steep negative divergences, which are now confirmed. I talk about, when I talk about current technical developments, this is one, for example, we just recently had. You can see the lines here on the PPO, a bearish crossover. That puts in effectively puts in a lower high on the PPO. As long as it was still going up, it had the potential to burn through those divergences, just as the Qs did a couple of weeks back or a couple months ago. However, we now have confirmed negative divergence pretty much across the board on all just about all the indices. And you can see even the Qs. Look at that crossover. If we zoom in, you can just make it out there. The day, we haven't closed the day yet. This would be the first day because of the sharp drop. But unless we have one heck of a rally in the last hour and a half of trading here, it's about almost 2:30 Eastern time as I do this video. We're going to have confirmed divergence there on the leader, the lead sled dog. Huge bearish engulfing candle. This is another technical development. A bearish engulfing candle just means this candle, although it did engulf yesterday's because we gapped down, basically what it's doing, it's wiped out all these gains for the past, well, right now, look, we're almost back to wiping out all the gains all the way back from the beginning of May, pretty much. And again, the market's not closed yet. We're down almost 2% on the Qs. But that is extremely bearish price action. Other technical events, we had this minor uptrend line. I can show it to you better on the 60-minute, which I'll do here in a second. And you can see this is a pretty significant support level. This is the first support line I have. I have that line around, which pops up. You can see the pop-up box here, 129.46. So we'll call that 129.50. Here, I'll show you that level. That would be one of the shallower targets. But I do have to say there is some decent support here. This would be my first price target. So I'll tell you how I think this will play out at this point in time. Call that 132.90, give or take, 133 if you want to be safe, somewhere around there. So you see there's a gap above it. Now I expect that gap to be filled, and I don't even think we'll have much of a reaction there. Normally you might go long on the initial test of a gap from above, and that was a key gap. That was a breakaway gap, you can see here, where we broke above this trading range. But I think we're going to come back in, backfill that gap. This would be your first area where you might expect a reaction. And when I say expect, there's a lot of hot air right now in the market. Sometimes you see these early support levels, the ones where most eyes think you're going to get a bounce, those can get sliced right through. But I can tell you now, I'll be at this point in time, as of today, I expect at least a reaction there. And that a reaction may be a consolidation for a day, couple days, 3 days a week, maybe a bounce. And then we'll go from there. And if and when that level is taken out with conviction, ideally after a bounce or a consolidation, then I think we go down to 129.50 area. And then we'll just have to take it from there again, see how the charts develop. So I'm spending a lot of time on the Qs because that has been the leading index. You have to, until the lead sled dog is taken out, the rest of the indices, as the Qs have been doing, it'll continue to buoy those indices. And don't forget, Apple's the largest holding of not only QQQ, also of the S&P 500, the SPY. So here's a 60-minute chart, very steep negative divergence. I recently put up a 30-minute chart and showed some levels there, and even showed the PPO crossing down into bearish territory. That was a whipsaw signal. I should have made clear, as I often do, my go-to charts on swing trading are the 60-minute and daily time frames. Anything under than that, shorter term than that, 30-minute, 15-minute, 5-minute, they're good for day trading. They're good for getting early signals, but they're more prone to whipsaws. Just as the daily chart even is. If you wait to the end of the week, you see a bearish breakdown on a weekly candlestick, meaning the end of trading on Friday. That's a better sell signal than a break of support, even on a daily time frame. So pretty much the longer back in time you go on the time frames, the higher probability those sell signals are, or I should say, there's a reduced chance of a whipsaw signal. However, so with that being said, unless we, we may get a little reaction. You can see this is a pretty well-defined support level here, and we're coming up on it now. So maybe a little bounce there. My guess is we're going to close right on that level or around there, and that would still be a little more downside. We're now down about 2%. Where we go from there, we'll see. So maybe a little reaction, a little bounce from there, but I'll be watching it because that will have put the PPO signal line, the 9 EMA, the last of the two to cross, which right now is just about on the 0 line. And I also have this trend indicator here. You guys know I share a lot, the 1333 histogram. That's just the 13 and 33 EMA pair. Instead of plotted up here with lines, I use the histogram to represent when the 13 crosses above or below the 33. And it works as pretty well as a trend indicator, a short-term or near-term trend indicator, you know, talking a couple days to a few weeks, occasionally a few months. You can see it caught a bearish trend right there, and it told you the trend was bearish here, and everything else not circled, the trend was obviously bullish. Same thing with the 9 EMA signal line, and you can see they're going to really move almost in unison. When one crosses, the other usually confirms. So those are my trend indicators. And being that this sell signal still pending, we've got it there so far on the 1333. Let's see how we close the day. I'm assuming it's going to go through. Everything I see in the charts means this won't be a one-day wonder. I don't think this will be bought up. But you can see the negative divergence we had here building into the recent highs on the 60-minute, very clear divergences, and then that minor trend line break with impulsive selling too, and that helps to validate a breakdown. So nice volume below. And I already gave you the levels, I think, yeah, on the daily chart. Those more for swing traders. These are all micro levels if you want to try to game bounces. And again, you know, you can drill down to the shorter term charts. I don't have all these marked up right now, and try to get an idea. For example, as we fall to this level, if there's bullish divergence on a 15-minute chart, maybe we get a bounce. But I can tell you personally, with the short positions I've had, and I made it clear in the trading room recently and elsewhere, I'm short via futures, put options, and just mostly tech. A lot of tech, a lot of semis, NQE minis, TF, things like that. And I don't plan to try to game any of these near-term bounces right now at this point in time. We'll see what happens. All right, let's just go over the top components because they need to break. Until the leaders break, this market is still intact. Here's Apple. I put this chart up recently. This is the key trend line, this uptrend line. Look how well defined. Numerous reactions, beautiful reactions right off that trend line. And I just recently posted this chart in static form the other day. Bearish rising wedge right here with divergent high. The divergence is yet to be confirmed actually on Apple. You can see the PPO hasn't crossed over, but it's certainly pointing lower now. I just like to see that crossover for confirmation. I think Apple, like I said, I showed you here, I think it's poised from where this is from where I posted the other day when we were up at the top of the wedge. I'm looking for at least a 14% correction in Apple and quite likely an 18%. So call that my first target, and that's my second target. And this would be your first support level here, about 145.70 or so. And if that gets taken out, that opens a door down to that 133.60 level. And ultimately, quite possibly that 127 level. So that's Apple. Yet to break down, but watch that trend line. That'll be your first indication that the leader, the heaviest component of the NASDAQ 100, the S&P 500, the world's largest publicly traded company, et cetera, et cetera, et cetera. That will show you that one's broken down. That's a 60-minute chart. Don't see much there. Here it is on a 2-hour, same trend line. So again, you can just see the trend line there. There's another possible uptrend line. So there's a confluence of support right here on Apple, not too far below the stock. You have the trend line, you have horizontal support, and then a minor uptrend line there. So looking at this, I could see a breakdown of this trend line, come down to here, maybe kick back, find support there, come up, back test the trend line from below and fall down. That would be an ideal scenario. So if you want to short Apple, or if you're long Apple, congratulations, congrats for sure. If you've been long Apple for a while and you're looking, where to sell, well, that might be your first sell signal breakdown there. And if it does, and you get a kickback to back test the trend line, that would be the next place you might consider exiting. And I don't see really any support. I shouldn't say any, but any decent support down here at about 127. There's that big gap that will be tested at least from above, I think, on Apple, if not from below. So there's Apple, negative divergences. You can see the yellow lines here. There was a divergent high with these white lines here. It did lead to a little correction, but we pushed up. This looks like a little blow off top. High volume, negative divergence, so I think we're going lower. And I'll fly through the rest. There's Alphabet, GOOG. Some people trade the other Class A. This is, and that would be GOOGL. Basically the same charts. I just use this one to keep it simple. This is a 60-minute. You can see a trend line. Not the best defined trend line, I'll give it that, but there was a divergent high right there. You can see the negative divergence, very steep and clear, and we've broken down. We have a little bit of support. So this is what I'm focusing on. A lot of these stocks, like that trend line in Apple I just showed you, is just below. Here's a horizontal support level in Alphabet. We have a gap right here. You can either use that area where we opened up at the top of the gap. There was a little reaction below that. That would definitely be support. And if that fails, which I think it will in the coming days to weeks, then the probability is very high you get a backfill of this a backfill of the gap. Gaps usually once entered, at least on the first time, they're usually backfilled. So look for something like that if we get down there. So that is Alphabet. Daily chart, same story. A lot of trend lines here. And you almost have to go out on this TC2000. I click to a 2-day period, so it'll show me 4 years where every day's, and you can see that divergence. It's just been building for, gosh, over a year now. Big, powerful divergence. And for that, that helps formulate the bigger picture that I'm not looking for a little 3-5% pullback, a quick gap backfill. I'm looking for, move down to this primary uptrend line, most likely a reaction when we hit that trend line. But based on the divergences and everything else that I've covered for months now, we can see, there's a potential for a much bigger correction. But first things first, and that's why I'm going over the 60-minute charts. And I know there's a lot of you that think this market's, headed quite a bit higher. So I'll give you, the nearby support levels, and you decide if you want to go long there or look to position short on a break of those levels. That's trading. You can take either side of the trade. It can be tough to call the markets, but I think where my skill sets lie is identifying key support and resistance levels. Whether those levels hold or not, that's yet to be seen. That's even a little more tricky than identifying the salient levels. So here's Microsoft. This is a daily chart. Negative divergence. Again, you have to go back to a 2-day period, go 4 years of history, and you can see how steep the divergence is. You can see it right there. You see this minor trend line here. We had an uptrend line there that was already broken, but prices crept higher. So this is the one I'd watch right here. In fact, this trend line here, the uptrend line I just pointed, the minor uptrend line, forms a parallel price channel with this uppermost trend line that defines the divergence. So keep an eye on that one. Again, I have bigger fish to fry, or I think there's better opportunities out there than Microsoft. But if things get pretty ugly, I think Microsoft can come back in here at about the $58 area or so. And again, that's not a straight down shot. There'll be some zigs and zags along the way, but that would be an ideal swing target. 2 more. Amazon, powerhouse of a company. Again, we almost have to go back to a 2-day period to really make out how steep and powerful these divergences are, how well defined the uptrend line. The divergence lines they're significant in identifying those divergences and a potential trend reversal, but it's these uptrend lines, when they break, that triggers a sell signal. So there's a negative divergence. You can see a big rising wedge type pattern, but most importantly is this uptrend line. And that's a 2-day, 4-year chart. Here's a daily chart. And you can see these 2 lines that I'm highlighting here. That's a small rising wedge. So for that, we have to flip down. When you see something like that, or at least when I see that, I zoom down to from a daily to a 60-minute chart. And here's that trend line. It's pretty well defined. A lot of reactions off it. And we had a divergent high at this point. We had a little correction, but that still took us back within the wedge. We're getting really close there. This is a point. If this wedge is going to break down, it needs to do it about now. You want to see this wedge get to apex. It just tends to foil the pattern and reduces the chance of a breakdown. So it's pretty much go time for Amazon. And right now it is creeping below the wedge. Divergence is confirmed. Trend indicators are still bullish on Amazon right now, but I would put a very, very good chance that it's coming back into at least this. It's going to break that. Well, I'm sorry, it already broke the wedge. It will continue to follow through to the downside and come on into this. We'll call it 925 level. Pretty good, pretty well-defined support level. And if that goes, I'd have to add some more lines to this chart. If you guys are interested in trading any of these names, just let me know and I'll be glad to put up more levels. Like I said, right now, because of that concentration in those big five, I think they're going to crack it once. And this is one of those cases I don't mind trading an index. I usually trade individual stocks or sectors, but when you short the QQQs or the NQ, basically you're just shorting these five stocks I'm covering right now. And this is the last one. This is Facebook. It's kind of a busy chart, a little triangle pattern there we broke down from. I think we need to look at a daily chart to get the bigger picture on Facebook. Here it is. Rising wedge pattern, a deeply overbought level, an extreme overbought reading. Almost, what is that, about 80? Gosh, I think that's 87 almost. And it looks like a breakdown there. And yeah, I'm not trading this one individually. So if any of you guys are and you want levels, just shoot me a line in the trading room. And I think that's about it. I can touch on the semis. I know I got a lot of questions. I've stubbornly held tight to this trade because I've been adamant that a big drop is coming in the semis, and I still believe that to be the case. So we broke down from the primary uptrend line, which was I figured that was a sell signal, and it was a sell signal, but it proved we had a back test. And we actually went just briefly yesterday or so above that trend line, but we're back below it now. Divergent high, overbought, everything I like to see. And this one has more meat on the bone, in my opinion, than a trade on the QQQ. In fact, even from where we are today, not counting the 3.3% drop, I still think that one's coming down to at least that 74-ish level. That's another 10% downside in the semis. And, as always, there's individual names. Some I like more than others, and recently I was long QCOM. That's still one long on the site. I don't even check how it's doing today because I mentioned I sold that one last week. Oh, looks like we may have hit our price target today, so I need to put an update there. 55.88. Yep, with a high of 56. So Qualcomm hit the first target. If I was still long, I'd be selling it today. I took it as a hedge, both as a hedge, and I thought the chart looked good. It's a bottoming play, but there's certainly a chance for that second target, but there's probably a pretty good chance we get a pullback here off this first target level, and you might be able to buy back in cheaper. So one option is to just place a tight stop. If they take you out, let it go. And if you're bullish the semis or bullish this stock, another option is to wait till they take out this level. T1 is set just below the actual resistance level, which is 56.15. So you need to see 56.15 get taken out with conviction, not 55.88. And even then, again, I wouldn't take it on just an intraday pop. I'd like to see it consolidate a little bit here first, but that's that. All right, let me wrap it up here, guys. I'm going to put an update out on this QCOM trade and try to update any of the other trade ideas that need to be moved to the completed trade category. Or that have hit profit targets. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.